Hey guys, in this video, I'm going to talk about the mistakes that costed me 50%. Yep, I lost 50% on these 4 positions in my portfolio. So we're going to dive in, take a look at what happened, what went wrong, and the lessons learned that we could take from this. I'll also throw in a 5th stock that recently tanked pretty hard and talk about what happened there and why the stock is falling. If you guys can guess that stock, let me know in the comments down below, but we'll talk about that a little later on. First off, let's talk about the 4 stocks that have dropped in my portfolio by about 50% or more. We've got Kits Eye Care, Real Matters, MCI1 Health, as well as Acuity Ads. MCI1 Health is a company that I'm down about 55% on. And the original thesis for this company was because they were getting into the medical data space, where they would take medical data and obviously anonymize it and sell it to other customers. And this is a very lucrative business. The company has over 1 million patients worth of data, and that data is worth anywhere from like $60 to $300 per patient. And this data could be sold over and over again. And some of you guys might think that this is a breach of privacy. However, I think that there is value in selling data in order to make better products in the future. If you want better healthcare or treatments or drugs, how are these companies going to know what exactly to make if they don't have the data to back up their products? So for me, I don't really see any issue with that. Maybe for you, you do. But in the long run, I guess MCI1 Health should benefit from selling their data. And when that revenue starts kicking in, the stock could go on fire. But right now, it really sucks to see this position down 55%. And honestly, sometimes I think about just selling out and saying that, screw it. Like, I'm down so much and maybe there's no hope for this company. So right now, I'm caught in a tough position where I could either hold this falling knife or cash out right now, take the L and invest it somewhere else. The stock right now doesn't show any signs of stopping its fall. It fell from the time that I started buying it around the $3 mark, and it's right now sitting around $1.50. They IPO'd at around $5 per share. And I did see the CEO did buy some shares around $4. So he was bullish enough to purchase his own company shares as they were falling. I think one of the main issues right now for MCI1 Health, as well as all these other small cap stocks that are down 50% of my portfolio, is the fact that many companies IPO'd in this past year. There's a lot of exciting technology out there, especially over the border in the States, that investors are not investing their money in these small cap Canadian companies and taking it to go over the borders and invest in exciting IPOs like Rivian. And ultimately, what drives prices in the stock market is supply and demand. So if there's a large supply of stock out there that investors are willing to sell, but there is not the demand for it, then the price will fall. And I think for MCI1 Health, investors who got into this are either retail investors or small institutional investors or algorithmic traders who are trying to make a quick buck. And when they don't see a huge pop in the stock, they end up dropping it like it's hot. It's just simply from the fact that people are looking to get out of the position. There are no buyers there, so they have to continue to drop the price that they're willing to let go of the shares until a buyer comes in. But if this company is so small that nobody knows about it, or very few people do, then there are no buyers sometimes. Turning our attention over to Acuity Ads. I first bought into this position because of their Illumin platform. And my thesis is that Illumin should drive higher margin revenue going forwards, and this platform is new and exciting, easy to use, and should drive major revenue growth in the future. And Illumin is driving major revenue growth. It grew about 40% in this past quarter. But the reason why Acuity Ads dropped very sharply this past week, it's because the revenue growth was lackluster. Acuity Ads reported only about a 6% revenue growth year over year. But if you look under the hood and beyond the headlines, we can see why that happened. The reason why they gave is because supply chain issues. A lot of their legacy customers who are on their lower margin platform, those legacy customers are having business issues, not being able to get product in and sell it to people. So they have to cut their ad spending. That lower margin revenue segment is still a significant portion of the revenue. I think it makes up maybe about 60 to 70% of the revenue, while Illumin is the other part of it at around 30 to 40%. But Illumin is slowly picking up, or actually should I say quickly picking up. With a 40% growth in revenue on this platform shown in this past quarter, That is where my thesis lies. So for that reason, I'm continuing to hold Acuity Ads. I'm not sure if I want to buy in a little bit more because I've sized my position correctly. I only have about $2,000 in it, and I'm comfortable with that. But in the meantime, continuing to catch this falling knife could mean more losses in the future. The third stock we're going to talk about here is Kits Eye Care, and I'll make it short and sweet. My thesis for Kits Eye Care is that the CEO has done this before in the past with a previous company, and they sold the company at a much higher price than it IPO'd for. And now he started Kits Eye Care, and because he's done basically the same business, he should be able to take this company to new heights and possibly sell it off down in the future. Unfortunately, the stock did drop 50%, and that's because of earnings, I think. I saw that the stock dropped after earnings reports came out, and maybe the report wasn't as good as people thought, or investors were hoping for a pop, didn't see it, and just decided to sell out and didn't want to hold the stock anymore. Again, Kits Eye Care, just like the other stocks, are competing for investor dollars, and when investors are not seeing a return on their investment, especially in the short term, they sell out quick. The fourth stock we're going to talk about here is Real Matters. And this stock, I'm still bullish on for the medium to long-term future. This company is cash flow positive as well as they have positive earnings. Their PE ratio is around a 20 or a 10 right now, last time I looked. I think this company is being hit because of the momentum of the stock. If you look at the charts, they've fallen from grace when they started at $33, I think a year ago in the summer, and they continue to drop and drop and drop. And currently the stock price sits just under $10. So a lot of algorithmic traders are probably playing off of this or maybe even shorting the stock and trying to push it even lower and lower. But fundamentally, the business is still growing, albeit it's not growing at like crazy rates that would turn investor eyeballs, but it is still growing slowly and steadily. In the meantime, the company is buying back their stock continuously, and they're continuing to operate a cash flow positive business, meaning that in the near term, they won't need to raise money in order to fund their business going forwards. At this point in the video, if you've enjoyed this content so far and found it insightful, leave a like down below, as well as if you got any comments on what I should do going forwards, or maybe some of the things that I said in this video you disagree with and want to share your thesis. I'd love to hear your thoughts. At the end of the day, I don't know everything, and I can't know everything because there's so much information out there. So maybe you could change my mind and cause me to buy more of a position or even sell it off in the future. Lastly, jumping over to Lightspeed. This stock got hit very hard recently. It was a high-flying stock. At the depths of the pandemic, the stock was priced at $14 per share, and at the peak just a couple months ago, it was sitting at $160 per share. Now it has fallen from grace and is sitting around $90 per share. Albeit it was very expensive when it was priced at $160, but who knows? Investors are crazy these days. They're willing to pay astronomical prices for some of these growth companies out there. Now looking at the facts as to why Lightspeed dropped. There were two significant events that happened. The first drop happened from around 160 to 120, then it stabilized for about a week or two before later dropping down from 120 to $90 per share. The first drop happened because there was a short report that came out. And that short report, I read through it, did a video on it, so if you want to check it out, you can see that video on my channel. But basically the short report I felt was very misleading. A lot of the facts that they talked about for Lightspeed were nailing the company on things that happened way before their IPO. For example, they may have overstated revenue or overstated the number of customers. However, that was 6 years ago. Like, come on, guys. And then they try to relate that to current days where they're saying that Lightspeed is concealing some important information, or they stop disclosing certain information because it might make the company look bad. But if we dig deeper into the information that they stopped disclosing and the timing of that information, the timing, guys, that is very key. They stopped disclosing this information when the whole pandemic happened. But what the short report is saying that Lightspeed stopped disclosing these metrics on their annual reports or in the conference calls because they were scared of other things. And if you read the disclaimer of the short report writers, they all have a short position on Lightspeed, meaning that they are to gain if Lightspeed stock goes down. And when a short report comes out, a lot of investors get scared, they don't do the research, they don't read through the paper and try to figure out if this is true or not. They just see the headlines and sell the stock right away. And that's the biggest mistake that people are making with Lightspeed right now. Not digging into the facts and just jumping to conclusions based on headlines. So that's what caused the first violent drop. The next violent drop that we had was because of the latest quarterly reports. The headlines were very negative about it. They cited lackluster revenue growth as well as losses tripling. And the reason why Lightspeed is losing money is because they're investing in growth. So they're growing their sales and marketing, acquiring companies, as well as growing their R&D. They're investing in the business and trying to grow that as quickly as possible and capture more market share before other people do. And if they're able to capture market share, the customers that they capture, they're basically going to be stuck to Lightspeed's platform because it's very expensive in both time and cost to switch from Lightspeed to another platform. So Lightspeed's revenue should increase as those customers continue to grow their business. And that's the whole idea behind investing in the business and having short-term losses. Other things that they cited in the earnings call for why the business did not perform as investors expected is because of supply chain issues. Lightspeed deals with retailers, restaurants, golf courses, and other entertainment. And if you look at retailers, a lot of them were having supply chain issues in the past year. Right now, prices are going ballistic on a lot of goods and services because there just is not enough supply and the demand is rising with Christmas coming around the corner. On top of supply chain issues, Lightspeed is also seeing customers face lockdowns. These are in Australia. So it's very understandable why revenue growth might not have been there. However, I think that they might have some blowout quarters coming in the future because if you look at the lockdowns in Australia happening right now, there's going to be pent-up demand for those companies who are shut down right now. So when they reopen, they should see a boom in business. And that will also in turn have a booming effect on Lightspeed's revenue. So if you've always wanted to get a piece of Lightspeed, consider Lightspeed right now. So after talking through these 5 stocks, here are the lessons that I've learned. The first one is to not catch a falling knife. I should wait for the dust to settle, which is basically setting a period of time where I need the stock price to stay pretty much range bound or at least see a recovery. The second lesson that I have here is to not invest in every single small cap that I can see when small caps are on fire. I think that last year when small caps were just going up left, right, and center, yes, there was FOMO, and I also fell into that. If you guys know me on my channel, I'm very transparent about my investing, and I'll show you guys stocks that I'm losing on as well as stocks that I'm gaining on. I'm not going to hide the truth and pretend that I'm some super investor because at the end of the day, investing is a bit of luck as well as some skill. So yes, I've gotten very lucky on some positions and never saw that coming, but at the same time, I'm trying to learn from all my mistakes in the past and make myself a better investor going forwards. So hopefully the mistakes that I make, you guys won't make the same ones. Now to end this video off on a positive note, not everything's doom and gloom with my portfolio. Yes, this portfolio, I guess you could say, mimics somewhat of a VC portfolio. Because venture capitalists, how they invest is basically spread their money across multiple different companies, maybe hundreds or thousands, and expect only a handful of those to create the returns for the portfolio. For my portfolio, what I'm seeing is some stocks are dropping 50%, while others I'm gaining 50, 100, or even 200%. So in this portfolio right now, I have 6 stocks that are over 50% gain. These stocks are Waste Connections, Storage Vault Canada, Shopify, Hive, Docebo, and Converge Technology Solutions. 2 of these stocks I'm up around 100% on. These are Storage Vault Canada as well as Converge Technology Solutions. So when I started this portfolio about 2 years ago, focusing on growth stock investing, I very well knew what I was getting into. So if you guys are planning to do growth stock investing, just know that you're going to see volatile swings in your portfolio, especially in a market right now. Remember to spread out your risk, size your positions correctly, and don't catch a falling knife. I've got a couple of videos up on the screen here. If you're interested in those, you can check them out. If you're there, I'll see you there. If not, keep up the grind and have a great day.